Hello and welcome to a brand new edition of Inside Out on the Road, a show where we'll focus on individual stocks with in-depth analysis, deep dive into the financials and tell you about the key risks and triggers going forward. So let's not waste any time and get to our first stock today. My colleague Nigel gets us this very special deep dive on Tilaknagar Industries.
Inside Out on the Road has travelled to Tilaknagar Industries. Well, they're the large brandy manufacturer and they have presence across IMFL. Brandy accounts for around 90% and South India accounts for around 85% of their volumes. The portfolio comprises of two millionaire brandy brands, that's Mansion House and Courier Napoleon. They also have presence across gin, whiskey as well as rum. Well, operationally things have been looking up. They've achieved volume growth of around 28% in the first half of this fiscal. That compares with around 3 to 4% for the overall IMFL industry. Brandy continues to gain market share while Flandy is being positioned as an aspirational and a youthful drink. Their volumes in the second quarter of this fiscal, well, they were 50% higher in comparison to the same quarter pre-COVID. And the net realizations per case, that's improving on account of a combination of improved brand and state mix, as well as the price increases they've received in the state of Telangana. Now, higher volumes with better realizations, that's what's led to a big surge in the top line growth, and that's backed up with margins at around 13%. And this despite the increase we have seen in ENA prices. The biggest positive though has been the reduction in the interest levels. That's down by close to around 75%, and the net debt has come down from around 500 crores to around 140 crores. The company says they want to be near debt-free by March 2025. Let's wind this down with the shareholding pattern. The promoter entry holding has come down to around 40%. They sold some shares to release the pledge on their holdings. And since they've become debt-free and pledge-free, it'll be interesting to see what they do with their cash flows from here on. Well, the management has mentioned that the focus is to increase market share in the existing as well as new geographies through robust growth in their brand portfolio. Well, let's not waste any more time. Let's get straight to the management who's waiting by. Well, thanks so much, Mr. D'Souza, for speaking to us here on CNBC-TV18. Plenty to talk about in terms of the IMFL market as well as your company. But before we get to that, tell us the backstory of Tilaknagar Industries.
So, Nigel, the company was founded in 1933. We're 90 years old right now. Mm-hmm. It was founded by my great-grandfather, affectionately known as Amit Dahanukar.
Okay.
And he took inspiration from Lokmanya Tilak's Swadeshi movement,
okay,
which was the Make in India movement at that time. And we set up one of Maharashtra's first private sugar factories.
Right.
And as a token of respect to Lokmanya Tilakji, the complex was named as Tilaknagar, and that's how we get our name Tilaknagar Industries.
Right.
And over a period of time, then we migrated from sugar business into alcohol and then branded liquor.
Oh, interesting. All right. So that's how we move from, from a sugar industry to the distillery and current business as well. Let's focus on the IMFL market first up. Your core business is brandy basically as of now. Tell us how large is the industry, the IMFL industry here in India, and how much does brandy constitute of that?
So the IMFL industry last year, FY24, it closed 385 million cases.
Okay.
With brandy constituting roughly 20% of the entire industry. Of course, whiskey is the largest category, approximately 60%, and the second largest after whiskey is brandy.
All right.
And the entire IMFL market grew by approximately 12% last year.
And how much is brandy growing by? And I believe that, Tilaknagar Industries and the brands that you have, the brandy brands, they are growing at a faster pace. So give us a couple of numbers there.
So, Nigel, I mean, if we, split the entire IMFL industry, I think there's a category prestige and above, which is predominantly, where we operate. Mm-hmm. And prestige and above, the category has been growing at 8%.
Okay.
The CAGR over the past 3 years would be 8%. Whereas if you look at the non-prestige and above, that's grown at a CAGR of 4%. So clearly the growth which has happened over the past 3 years has happened in the P&A category.
Okay.
And within the P&A category, brandy has grown the fastest.
All right.
In fact, brandy has grown at 13% in these last 3 years, CAGR, prestige and above. Predominantly, of course, it's been led by two of our flagship brands, Mansion House and Crore Napoleon. And I think there is an attractive opportunity for us because if you look at the other segments like whiskey and vodka, the P&A category is almost 50% of the total industry over there.
Right.
Whereas for brandy, it's about 30%.
Right.
So I believe that there's headroom for us in terms of premiumizing this brandy space. I mean, currently it's only 30%. It can potentially grow to that same number which is there in whiskey and vodka over the next 3 years.
And for Tilaknagar Industries, P&A is bulk of your brandy sales, right?
P&A is bulk of our brandy sales. Approximately 85% of our sales are prestige and above.
Got it. Brandy seems like an old, jaded drink, but you're trying to reinvent it, right? What are the measures you're taking out there? I believe Flandy is something that you're looking at.
Yes.
Tell us more about that.
So Flandy is an industry-first innovation. It's flavored brandy, launched just last year. We've launched it initially in three flavors. There's peach, cherry, and orange. We're present in 3 markets. But the interesting thing to note, Nigel, is that even in the first year of launch, it's the volume is about 5 to 10% of the flagship brand Mansion House, which is quite encouraging for the first year of launch. So we're seeing not only a lot of upgrades of the existing Mansion House customers trying out Flandy, but we believe we're attracting a new set, younger generation is being attracted to Flandy, which could be, I see it as a good potential going forward. We have a younger set of customers, looking at brandy in a different way.
Well, that'll be interesting to see how it works because, in today's day and age, when you have gins that are coming out and you've made some moves in that direction, we'll talk about that in just a bit. But you're trying to make brandy a little bit more spicier, so to say, and that's why you've introduced Flandy. And as you're saying, that it's getting a fair bit of traction on ground. The problem from a shareholder's perspective is they think that, Tilaknagar Industries is focused on brandy, which is more than 85% of your volumes. And also, you're south focused, which is again more than 85%. So, what are your plans in terms of de-risking this? Say, how much can non-brandy contribute and how much can non-south contribute as well in the time to come?
Sure. So, I think it's a good question. We should keep in mind that, Tilaknagar is brandy first company. I think we have 2 millionaire brands in Mansion House and Crore Napoleon. The Mansion House range we're expanding now. We've had Flandy, which is launched last year. We've had a premium version of Mansion House called Chambers, which is being rolled out as we speak. We are present in Puducherry as of now. So that's as far as, we are a brandy first company, but over a period of time, and I think we'll remain that, for the next immediate short term, 18 to 24 months, we see ample headroom to grow within brandy. If you look at, say, the next 5 years, I would like at least 20% or aspirationally 20% of our portfolio is non-brandy.
Okay.
And I think what will happen going forward is as the company frees up cash flows, as you might be aware, we are becoming debt free quite aggressively. So cash flow is going to be freed up, which will allow the company the liberty, the opportunity to explore new product categories and new geographies.
So new geographies. So say if you had to put a number to it, you told us non-brandy will contribute 20%. Will non-South as well contribute 20%?
So,
is that the goal?
So that's a difficult one because, Nigel, South is a very large market. Out of the 385 million cases which we spoke about earlier, South is more than 50%.
Okay.
So itself is a very large market. So it's difficult to quantify or really predict what would be the non-South, revenue profile 5 years down.
Well, Mr. Dahanukar, you've made good amount of progress both on the volumes front in the first half of the year as well as on the NSR part. Now tell us, where do you end this year with? Because at the half year mark, you're doing much better than what you had done at last year's mark.
Yes.
So where do you end this year with? And what are your scaling up plans in terms of volumes as well?
So we should be ending this year with a growth from the mid to the high teens. Of course, it's been aided by significant growth in the first half, which happened on a lower base in the past year. I think the lower base was probably because we had the big infusion of funds from Think Investments only last year, which gave us the adequate amount of working capital needed to really push through the channels. So
all right.
We should end this year between say 15 to 18% growth.
Okay, and the other part is the realizations. You've moved to around the 1200 odd band, and you've moved a couple of ₹100 in the last few years.
Yes.
One part of it is from the regulators or from the state governments that give you that go ahead with regard to price increases, but also you're working on your product mix. So where do you see this number headed from current levels?
So we've had a significant increase in the NSR, Nigel. I think if you look at the recently concluded quarter, NSR probably ended 1273, and the same period previous year was approximately it was 950. So there's been a very sharp increase in the NSR. Of course, it's been led by price increases in some of our key states by the regulators, but also what has contributed is our evolving product mix, where we started to focus more on our premium range. So it's been a function of the price increases we've taken and the product mix which we sold. So I think that has contributed largely to the improvement in the NSR. Going forward, I think that will be part of the plan, in terms of the premiumization trend which we have to improve the NSR going further also.
Okay, so we've got a fair idea in terms of your volume growth as well as in terms of your realizations. Now, input cost is something that's not in your control. Some of those costs have been spiking up and some of them have been fairly volatile.
Yes.
But as a company, you have done a good job in scaling those margins towards that 12.5%, 13%. What is a sustainable level? Given the volume growth, given the limited headroom you have on realizations, as well as the input cost volatility?
So for the immediate term, I think for this year, we will, probably end up with the EBITDA margin between, say, 13 to 13.5%. And next year, aided a lot by in terms of the changing product mix because of premiumization and a few cost efficiencies. I would expect it to improve maybe by 100 basis points. But going forward, if I look at a 3-year period, we would like to be somewhere in the mid-teens, so 15 to 17%. That's when we'll have operating leverage really kick in, as we scale the business.
So by 2026, 2027, you're saying you should be in that vicinity of around 15 to 17%.
Yes.
Okay. The biggest problem for the company, and some would have thought survival would be the problem, was when you had that massive debt in books.
Yes.
You brought it under control. Borrowing rates as well have come down. What's the outlook out here? I think you had briefly mentioned earlier as well that you want to be debt-free by 2025. So what do you end this year with in terms of debt?
Yes.
As well as 2025, you're giving that outlook, but do you think you can be debt-free sooner than that?
Yeah, so debt was, traditionally it was a big issue, company was grappling with.
I think debt was a friend till it became a very, very difficult enemy to deal with.
Yes, because at peak level, we were at 1,300 crores, including personal debt, because I had a significant amount of personal leverage as well at that time. So the company debt and personal debt put together, that was totaling 1,300 crores at peak. And we expect to end this financial year with a net debt of around 100 crores. So there's been a very sharp reduction in terms of debt, which I've guided earlier also. I mean, if you recollect some of our earlier conversations, we've been guided. And I think we are on track towards being net debt free in 12 months' time. With the trajectory which we have right now, the momentum we have, clearly, I think next 12 months we should be net debt free.
What is the rough capex you have? I don't think it's a very capex intensive business. Yeah. So what is the annual capex number that you could give us?
So I envisage in the range of 15 to 25 crores. Of course, the large capex, if we do decide, and of course we will make the necessary disclosures at that point, is the grain distillery, which has been an asset which we have not completed. There's a capex of around 50 odd crores, which is required to get it operational. As of now, we don't have a firm decision on that. But if I keep that aside, the maintenance capex will be around 15 to 25 crores. It's an asset-light model. To scale up our volumes, we have our partners, a lot of our large part of our business is channelized through third-party arrangements. So I don't see really a challenge in scaling it up. It's a function of demand.
Got it. Well, the recent piece of news that's come in on the company is that the promoter entity went and sold roughly around 1.5% stake out. Question to you is, do you plan on selling more stake? Point number one. And point number two, you just mentioned that on a personal level as well, you'll had some debt. Is that all cleared out now? Because it appears you're pledge free.
So just to clarify the promoter entity, yes, we did a sell down of around 1.5% through a block trade. And we had participation from some foreign and domestic institutions. I think the primary and only purpose of the sell down was that there was some personal leverage at promoter level. In fact, when the company was going through very distressed times and financial difficulty, in fact, the promoters had infused funds into the company. So there was leverage at a personal level, and that's entirely being settled now. And as a result of that, the shares have been freed up. So we had about 24% of the promoter share capital which was pledged, which has become fully encumbered now. So now there is no debt at a personal level.
And no plans to sell further stake as well?
No plans to sell further stakes as of now.
So you're pledge free, the company is debt free, you're going to be generating a lot of cash. Cash flows are going to be good for the company. I guess it'll be a couple of 100 crores odd. What do you do with that money?
So I think the cash flow which we'll generate, of course, we want to plow it back into the business. I think as we had spoken about earlier also, there could be opportunities to expand in terms of product portfolio as well, moving maybe perhaps out of brandy and out of non-South territory. And of course, those would require investments. So I think we will use that, to grow the business, I think.
Okay, all right, grow the business. Interesting. Give us some more details. You had invested in a couple of startups. I think you had around 10% in one or 19.5% in the other. What's the plan? Do you want to go and increase your stake out there? If yes, by when will you do it? Because some of these brands are doing very, very well under these startups.
Yes. So we have two investments, Nigel. We have a 10% investment in Spaceman Spirits, which they're the makers of Samsara Gin. I think the Pink Gin is doing incredibly well.
Yes.
And the other one is in a smaller startup. I think that's quite a unique product. It's a ready-to-drink shot. So we have a 19.5% stake over there. I think the idea was just to back, exciting products, innovative products, category-first products, and young founders, with passion to create something. So I think that was the genesis of our investment.
But now, if you'll have to go and increase stake, you'll have to spend a lot more.
So, we don't have any firm plans as of now. We'll have to just see. I think the idea was to support them when they needed that capital and grow those businesses. So those businesses grow, we are happy as well.
You're doing roughly around, going at a run rate of roughly around, I think, 1,200 crores approximately. At peak capacity levels, what can you do? You've told us that a lot of your production is third party. So at peak levels, what can you do with the current setup?
So the current setup, I think, is good. We can, since our model is asset light, right? We don't necessarily need to invest in factories, even if for example, if the sale doubles.
Yeah.
I don't need to invest too much in manufacturing because our arrangements are contractual third-party bottlers. So we tie up with them, and that's our route to market. So to increase capacity, it's more function of demand rather than capacity.
So if demand's good enough, then you can scale revenues.
Absolutely.
Final question then, sir. We need to ask you this. Things are looking up. The company now is close to around 5,000 crores approximately. If someone writes a big check and says, Amit, I want to buy the company, will you be a seller?
Not now. I think I've just got a new lease of life. I was saddled with 1,300 crores of debt. We've got it down to 100 crores. I think I've just made a start. So I think it will be too early for that. But that said, as promoters, as CEOs, no doors are permanently open or shut. So
does it depend on the size of the check?
No, I think right now I have the passion and hunger. I think, as I said, I think we're just getting started. So the journey is just begun.
Wishing you all the best in this journey.
Nigel.
And thanks so much for speaking to us here on CNBC-TV18.
It was lovely to be with you. Thank you so much.
All right, that was a deep dive into Tilaknagar Industries, but time to slip into a short break. We'll come back with another interesting stock. Saregama is in the spotlight on the other side. Stay tuned for that.